So this is, the topic here is quality of data, okay? And there are two sets of data that we typically use. One is Yahoo data, and that's free. And one is FastTrack data, and that you can either get directly, or if you use something like Sector Surfer, it uses FastTrack data. And the question has continued on about how good is Yahoo data versus FastTrack data. And so John went off and did some good work in terms of comparing comparing those data points between the two. He provides essentially 3 pages, an equity curve with both of them on there, meaning FastTrack and Yahoo. Second page in terms of the differences, okay, and a third page in terms of picking out the largest deviations. So one thing I'm still recovering from a cold, so I'm going to be coughing and wheezing, through the meeting here. So I'll apologize once and then forget about it. So it's one picture's worth 1,000 words. This is FSENX, which is Fidelity Select Energy, from '88 to, let's say today, a couple months ago, whatever. You can see FastTrack's in black, Yahoo's in red. You can see there's very, very, very little difference. Okay, so this is an example of good correspondence.
Is this total return?
This is total return, I believe. This is the difference calculation that John came up with, where he compares, okay, what does FastTrack tell me today versus what does Yahoo tell me today? And you can see most of the time it's very low, kind of a noise level that can be due to many things, including just there's only 2 digits of accuracy given, so you got some noise and rounding factors. What you see is the big spikes, okay, is basically when does one source post a dividend versus the other source, okay? And so I talk about spikes being balanced, okay, in terms of, okay, for each one of those, let's call it 5 major spikes, you can see that you got one going up, and then virtually at the same time you got one going down. This probably deals with when the two Yahoo versus FastTrack, when they post dividends or include dividends in their data stream. And here is an example of the max negative difference and the max positive difference. And again, you can see that they're virtually the same time. May 93 is the largest difference. And effectively, again, you keep on seeing the same phenomenon, posting a dividend one day versus another. All right.
You might go back for a second. You might have just noticed that the difference is just the returns are the returns in percentages, right? So the difference is just the difference in the percentage. And most of them, if you look on the right, are pretty small, and then for some that are like 2 or 3 orders of magnitude higher than the other ones. So those are the spikes.
Yep, those are the spikes. Thank you. All right, next up. Here is one of the quote-unquote worst examples of FastTrack versus Yahoo. This is Fidelity Select Electronics. Again, FastTrack is black, Yahoo is red. You can see that, there's a difference. All right. So one of the things dealing with bad correspondence is what I think of as unbalanced spikes, right? So you can see that there's a number of spikes, again, that are balanced, okay, in both the positive and negative direction. And then there's 2, in this case all the way back in '93, that don't seem to have a corresponding negative pulse, okay? That, and if you go back to this slide and look at '93, which is roughly this time period, okay, that's where they start to diverge, okay? So that gives you some idea of, yeah, there was some sort of problem in the data stream back in '93, and it's been there forever, And and it may be getting worse, in fact.
Have to press the button hard, the batteries are.
Santa
getting weak.
didn't bring me one of these.
Oh, shucks.
I need to get one of these. Thank you, Secretary, for the job.
Okay.
So again, this is 93, and that's where they split off.
So could that be the compounding effect of those two errors showing up?
That's what I believe it is, meaning that there's some difference in the data that is not compensated for, okay? And that's why you're seeing the curve start to split.
Well, it's that.
Any difference would come.
Right.
It's carried through, that's what you're
Yes.
saying.
Those curves look like they're almost offset by the same percentage.
It's
It's a log plot, right?
a log plot or semi-log plot, and yes, they're, you know, again, this is all eyeball from here, but it looks pretty close.
So it looks like there may have been one mistake at one point.
That's right. It certainly looks that way.
To me, it looks like it's growing. It's certainly much closer before 2000 than it is in 2000. So I don't think it's at all a simple offset. I think it's growing because there's errors creeping.
Yeah, so for example, to John's point, those two are unbalanced. Here's an unbalanced one. Now, what the heck's going on here, right? You know, those are too far apart to be, quote, balancing, okay? Here's another one where you've got a reasonable size spike.
Is it fair enough to assume that as it progresses over and if the variance becomes less and less, that the data is improving? I mean, you should look at the graph there.
Yeah, so what-
There's a wide variance.
Yeah, so what's happening is everybody wants to adjust their, do the dividend adjustment from today backwards, right? So they want the value today to match whatever value you get off of print, right? So they have to work backwards. So the error here propagates backwards, right? So if you accumulate it, it propagates forwards, and the farther forward you get, the farther off you get. But if you look at it backwards, you start at the same value and you go backwards, and that's why you see larger errors.
Sector Surfer about a year ago increased the precision with which it reported these values.
Mhm.
And that was very helpful on the left side of the graph.
So here's an example of what I mentioned earlier, a balanced spike, and here you see an unbalanced spike. So that is one example of an unbalanced spike. All right. So points to consider, and again, these the first set here really come from John. There's lots of sources of error, round off. The mutual fund companies themselves don't necessarily have good pricing. There's human errors, there's poor quality, there's no quality control per se, etc. Here's my list of quality data sources, okay? Pinnacle is reputed to have pretty good data. Possibly other proprietary sources as well. FastTrack, let me step back. If you want to spend $80,000 to $120,000 a year, you can get really good data, okay? If you have that kind of money, please see me, because I want to talk to you and become your friend, okay? These sources are, if you will, retail sources for most people that are affordable for most people. So you got Pinnacle, you got Profit, there's a number of other sources. FastTrack itself is proprietary. You got to pay for it, and then Yahoo, okay? Now, I and a whole bunch of other people you use Yahoo because I can put it in spreadsheets, I can give the data out because it's public, as opposed to really FastTrack and all the other paid for sources. You really shouldn't be giving out that data, okay, because people pay for it. If you've got a problem where you can use index type, or index, local indice type data streams, Ken French has got a wonderful data library in Dartmouth. For free, you can go in there and you can pick it up. This is French of Fallon French, okay, the famous people with from the 90s and so on, talking about, for example, different distortions in the market, for example, small caps versus large caps. So you can, in fact, get hold of that data. It's pretty much free. But in terms of free sources, really, that one and Yahoo. Google also has some historical data, not a lot. There are people out there, and I remember Bob Smithson, for example, used to talk about Google provides a live feed, okay, of various indices. And in Bob's case, he was actually capturing it for a wide variety of things, wide variety of instruments, and putting it in a spreadsheet. Okay, so if you want to, you can get good, high quality live data that way as well.